Okay, well, welcome everyone to today's webinar titled Budget Compliance, the Impact of Purchase Orders. This is Brian from Strategic Treasurer, and we're pleased you could join us as we consider how poor and manual purchase order processes contribute to inefficiencies and broken budgets, and explore the value of electronic PO processes. Our speakers for today are Alex Camperi, Sales Director at Corpay, and Craig Jeffrey, Founder and Managing Partner of Strategic Treasurer. Welcome, Alex and Craig, and I'll now turn the presentation over to you.
Thank you, Brian. Thanks, everyone, for joining us this afternoon or late morning, wherever you're located. We appreciate you taking some time out of your day to hear us talk and review some material, and for you to be engaged through some polling questions. Alex, it's good to see you, and this is our first webinar together, so welcome.
Thank you for having me.
Yeah, we're looking forward to it. So we have quite a bit to cover, and I know many of you come from the treasury domain. Others are payables professionals from procurement all the way to AP. So it's good to have a mix of finance people on today's webinar. But let's begin covering what our agenda is. So you can see on the slide before you 6 rectangles with little icons and images in each of them. This is our roadmap for our discussion. First, we'll begin with implications of procurement process, how it impacts other areas. This will touch on areas about efficiency of the overall business, and certainly of how a company acquires goods or services. It will touch on other implications like scalability, the ability of an organization to handle increased volume as they grow or as they acquire other companies, and also near and dear to the treasury people's hearts, has to do with the capital implications of the procure to pay process, demanding more capital or less, depending on how efficiently it runs. There's this reverberation that has an impact there. Then we'll look at the hazards of uncontrolled or manual processes. And this is along the lines of the opposite. A manual process tends to be more costly. It limits the organization's ability to expand. It uses or absorbs capital in a disproportionate manner, and can harm relationships significantly, also resulting in additional cost. They'll move on to this desired future state of electronic processes, digital, so where we're automating the tasks, how we move and look at data, the workflow, how workflows can support that, especially digital workflows, and move on to that discussion. And then we'll cover some of the key drivers to automate. So while your organization may be different from other organizations, there's certainly going to be some common ground. So some of the things that are driving companies to automate different areas of finance, including the procure to pay and the payment cycle, has to do this shift to remote work or hybrid work. That's certainly been going on for quite some time now, and there's been significant changes there. The ongoing and perpetual drive for efficiency, I don't think that ever lets up, Alex, as we look at this. It's just kind of a continual, you have to get more efficient as you go on. And then we'll also touch on a couple other areas, including one about Gen Z, the Zoomers, the generation Zoomers, who really not only hate manual processes because other generational cohorts probably hate manual processes, but they will stop doing it. They'll move to other organizations. And this can be disruptive to an organization, but can be also helpful in that they won't tolerate doing, let's just call it suboptimal processes that can be automated. And that's driving other companies to automate more of their processes. So if you're a Zoomer, thanks for tuning in, and thanks for pushing companies to automate. Then we'll look at points to consider. And these are the areas for opportunities when you look at automation solutions, moving from manual labor, manual activities, which create errors and defects, to the impact on capital and growth. And then finally, Alex and I will cover four areas, 4 takeaways, something to consider. So what's the impact? Having an automation mindset, automation first. What's your competitive posture? What are other companies doing in your business? They are automating if they're not already automated. And then the impact of efficiency versus inefficiency. So that's what we're going to cover today. We've got a lot to cover, and I want to start off. I'll introduce this slide and let Alex weigh in here. The procurement process is not just about procurement. It impacts up and downstream items and finance generally. Alex, what do we need to think about here?
Yeah, thank you, Craig. So when I was actually first asked to do this webinar, I kind of had the same question, right? A lot of the attendees are in treasury, they deal with liquidity and just kind of finance in general. And there are far-reaching impacts when it comes to, talking about a PO process. And it's more just about those downstream effects. So when I work with customers of, all various sizes and structures, the PO process, from my perspective, is the very first things that happen when a company needs to spend money. And so if there's no PO process in place, or there's not a scalable solution in place or structure that allows for scalability, this has pretty detrimental effects on budget allocation and liquidity. So it's best from our perspective to kind of implement a process that is scalable and far-reaching within the organization, creating standardized approval processes. So by the time the cash goes out the door, you and the finance team, the treasury folks, have a good understanding of where those expenses are being allocated to for budgetary, and then of course just cash flow management purposes.
Yeah, excellent. So, this idea that it impacts both the income statement and the balance sheet, and how Treasury looks at capital and cash flow. When you think about a financial statement time frame, we look at what does our income statement look like for the whole month? What does our balance sheet look like at the end of the month? But there's also all of the flows in between, and companies have to provide for liquidity during those times. And expenses and efficiency touches on each and every area. So, Alex, the next slide here shows a lot of steps. I know we got this roundabout set of rectangles starting to going to the end. There's certainly a lot of steps here. There can be many more in companies than less.
Yeah, so it's a very manual process, and it's not just about requesting a purchase order. As we can see from this grid here, there's a lot of various coding transactions and budget approvals, and of course the invoice and the payment. When those transactions are received into the accounting org, all that upfront work typically relates to the invoice to help speed up those approval processes and actually paying your invoices. So the procurement process in general, it's not very straightforward or consolidated. I know there's a lot of various audience members representing different types of organizations. I'm sure some of the organizations that you represent have a PO process in place. It might be manual. So I'm sure this slide resonates with a lot of you, kind of either without a PO process or with a relatively manual PO process. Just taking an example. So when I need to, let's say I'm a VP sales, and whoever in your organizations need to request spend, again, they need to go through these various steps in the spend approval process to actually procure, right, the services or the goods from the selected vendors, and then getting that invoice ingested into the process. So there's very manual steps, and then often in this process, it's very fragmented. So you have different stakeholders within the process. You've got a vendor onboarding team, a legal team, a procurement team. You've got your AP and your treasury folks. So again, this is kind of far-reaching and cross-departmental. And so this process, if it's not manual, it creates a lot of heartache and headache within multiple organizations or multiple departments within one organization.
Yeah, now, Alex, for those that are looking and seeing this chart with very many rectangles, there's almost this perception when you look at every arrow is equivalent, every rectangle is equivalent. That's not really true. It shows some concepts about the handoff. And that's what we refer to as the fallacy of the line, or I guess the fallacy of the rectangle, that they stand for different things.
Yeah, so because there's so many, again, different organizations or different departments involved, there's the person who needs to buy something, right? There's the approver, there's finance from a budget perspective, ensuring that this spend request is going to fall within our budget, and then all the reporting that comes with that. So because any spend request typically, again, touches so many different hands, and a lot of the time there's manual email back and forth, there's just so much room for error. And so this is why there's a huge focus right now in the industry and procurement. The accounting folks are talking about it, a way to kind of centralize and streamline this process, because it touches, again, so many different hands. There's just so much room for error and missed communication when it comes to audit requests, trying to look back and forth through email. Sometimes paper POs are processed. So implementing, again, a process that is streamlined and scalable, where all the information that lives in one place, you can see your PO records, your invoice records, your payment records, will optimize efficiency for the organization and allow faster processing times, and reduce, of course, any room for error within the manual human data entry or manual approvals that typically plague any organization today.
Yeah, and the image here with the going from the front door to your table or your chair can be shown by a line versus, and how much effort does that take? It's a few steps and you sit down. Just like the chart before, there can be a line between two areas, and whether something's manual or something's automated is a very significantly different process. All the steps are involved, possibilities for error differ. For errors differ significantly. And so just like you can have a chart going from the front door to your chair, that's a travel and transport, there's a line, versus going from the earth to the moon or something quite a bit more significant. And here we have the number of steps required to go to earth to the moon, how dangerous it is, how much it costs, and the effort is significantly different, though you can still show the concept with some simple lines. I think that's one of the key things when we map out flows, processes, whether it's procure to pay or other areas of the finance cycle, that we understand the effort and the work involved, like how manual is it? How automated is it? Those make a significant difference, and the impact are inefficiencies, errors, delays, and errors, that these defects add to time, damage relationships, increase our costs, limit our ability to extend and harm relationships, if you don't mind me saying it a second time. But that brings us to our first poll question. And this is fill in one. Our procure to pay process is highly automated, mostly automated, some heavy manual aspect, mostly manual. I am unsure. And one thing we'll do is, if we have people type the word pay in the chat box, if we have, let's just say 80 people type the word pay in the chat box, we will share the results of the poll questions. Just type the word pay. If you type the word poll, we won't be upset. It'll count. It just makes it harder for Brian to count, but that's what he has to do during these sessions when we're talking. But go ahead and fill those in when you get a chance. But once you select your option, you can hit submit. And that will register your vote, and then we'll be able to see what the results are. So this will be interesting, Alex, to see how many here focusing on procure to pay are highly automated, how many are mostly manual, and what's the mix. So with that, we can see the results. I'll give you a chance to comment on that, but I also wanted to point out the chat box. If you can follow Core Pay, Strategic Treasure, and then our media outlet, CTM File on LinkedIn, just go ahead and click those. Follow them on LinkedIn. That helps us stay in touch, makes our marketing team happy. So if you go ahead and do that, we'll be all that more delighted with you. So Alex, this is a pretty even mix. Mostly automated wins the prize, but we're around 15 to 18% for most of them.
Mm-hmm. Yeah, I love this. I love a diverse audience. So we'll kind of, tailor the conversation to apply to both groups. I would kind of group, highly automated and mostly automated, roughly coming in under about 50%, and the rest a little over 50%. And it's true when I work with organizations in terms of their PO process. A lot is manual, right? So that means potentially no PO process or a paper-based PO process and approvals through email. Mostly automated is, it's a good sign, right? That means that there is a PO process in place. Maybe there's some inefficiencies within that process. And then highly automated, I'd love to see that 15% of the audience today, their PO process is highly automated. So from my perspective, right, we've got a robust approval process built out. We've got spend control. We've got coding at the line level, potentially punch out, which I'd love to talk about today as well. Some punch out POs. I'm coming at this from a technology perspective, so I love the latest and greatest kind of technology, punch out, ChatGPT. That's kind of what really gets me excited. Helping organizations leverage that latest technology to further streamline these processes. But again, love a diverse audience. So I'll make sure we kind of tailor the conversation to apply to everyone.
Yeah, excellent. Thanks everybody for answering the first poll question. We'll move on. And again, just so you know, we had 40 responses, and Brian tells me that we need 40 more to send those results to everybody. So let's continue our dialogue. Controls matter across the board in finance because we're dealing with some of the organization's most liquid assets. I'll invite you to jump in here too, Alex.
Mm-hmm. Yeah, so I love kind of using examples, real life examples, right? So if we take an example of a VP sales, right? Let's say the leader of the sales organization identifies that they need a tool to help their SDR team, source leads, essentially find companies that potentially need a software. So VP sales identifies a need. He goes out to the market and, demos different products, decides, I'm going to purchase this tool called ZoomInfo. It's what we use for our outbounding efforts. So need is identified, right? Demo process takes place, scoping of requirements, ensuring it's a good fit, syncs with Salesforce. This is a real life example. Now, when that VP sales is ready to sign a contract with with the vendor, ZoomInfo, in this case, chances are they're going to send them the proposal. VP sales might negotiate because he likes to negotiate. But at this point, he doesn't have any visibility in a real-time budget updates to his allotted budget. So there's a big area of concern there. And then in addition, typically he's going to sign the contract. ZoomInfo is going to bill him for, let's say, $3,000 a month, $36,000 a year upfront for the entire license fee, since this example is related to software. So in that uncontrolled process, we have potentially overspending, right? VP sales might not know exactly how much is in his sales software budget. And when he gets that invoice, that's going to affect liquidity, because chances are you're going to have to pay that invoice up front. There might be disadvantageous payment terms embedded within the contract. So if we look at now manual controls process, so the idea here is to implement control when the spend request is initially submitted. So this is going to force the buyer to think through all of those scenarios. And when it comes to budget and coding that PO transaction to software expense, there can be additional layers within that approval process as well to prevent something that he may overlook. So something like, again, payment terms or billing terms, you can typically negotiate with the vendor to, advocate for quarterly payment terms or net 60 with a 5% or 10% discount, which again, at the end of the day, affects our cash liquidity. So it's all about that upfront control process and to influence behavior, the buyer behavior, to inform finance and accounting, all these downstream organizations or departments when the spend request is actually created.
Yeah. Now, as we look after the controls process or a controlled process, then we move over to the uncontrolled process where it breaks the budget or the cash flow. I guess as I think about this, the CapEx budget always lays out things by month. People shift things in and out, and the expense difference tends not to be too much, yet it can have a very significant cash flow difference. Why don't you walk us through some of the challenges of an uncontrolled process for the budget implications?
Mm-hmm. Yeah, I mean, I think this slide does a very, very great job at succinctly describing exactly what happens. So again, I think about this because we deal with purchase orders, on a daily to daily basis. So that's just kind of what my mind goes to, how these POs can actually be set up. So again, it really comes back to the upfront work done when the PO request or the purchase request is created. So in this first line, we have an ideal scenario, right? That example of the VP sales needing to buy a software system. When the PO is created, he's going to split that PO amongst 4 quarters or months in this case. So that's going to allow for appropriate budget allocation. So the entire, $36,000 or whatever it is, $50,000 contract isn't going to hit his budget for a particular just 1 quarter or one month. It can be split across various months. And then again, from the cash flow perspective, if the vendor is willing to negotiate on a billing term basis, you can have that cash flow come out from your bank account on a consistent basis instead of one lump sum. The downstream effects on the accounting side. So we talked about liquidity, how this affects cash, but also from an accounting perspective, because the work is done up front on the PO and the budgets are appropriately allocated. This gives accounting and finance accurate reporting data so they can run their budget versus actual and see, what has come in under budget and what is the actual spend, the cash that's gone out of the door. And so again, when the POs are created, assuming a control process is put in place and you're influencing your buyer's behavior, this affects not only budget, but again, cash flow and streamlined accounting processes.
Yeah, that's great. Uncontrolled processes they can be automated and uncontrolled if the automation of the workflow is done poorly. But we can also see how manual processes create challenges. And just as a setup, I'd like you to weigh in on this too, Alex, as the resident expert on AP and procure to pay. But here's my thinking on some of the subject. Anything that what creates significant costs and problems, both in terms of operational efficiency and in terms of capital. It has to do with defects when there's different types of errors. And what causes errors? Manual processes, poorly designed processes, a mismatch in timing issues, a latency issue. Those are the items that cause defects, errors, delays. They're costly. They prohibit expansion. And so the most fertile area, of course, is manual processes lead to challenges. I know I said a lot there, but that's my general view on it. But can you talk us through what we're seeing here?
Yeah, absolutely. So let me just kind of start off by saying a manual process is better than no process, right? You're in a boat, you got the boat pointed in the right direction. You're not there to the destination. You haven't made land. You're still in the middle of the ocean, kind of floating around. But again, it's better than nothing. It's a really great starting point, and it shows that organizations have identified the problem, which it is, as we previously discussed, there's a lot of downstream effects when you don't have any PO process in place. So manual process is a step in the right direction. Again, there's a lot of room for error. So just as I love to use live examples. So taking that same example, typically when a process is manual, it doesn't necessarily have to be paper-based. So obviously if it is paper-based, of course we can assume it's manual, but even if it's electronic, let's say, you've implemented a PO system, but there's room for judgment in who needs to approve the purchase order, or there's room for judgment in how the purchase order is actually created. So the idea behind manual process, again, it's better than nothing, but chances are if your organization hasn't taken a hard look at that structure and implemented scalable approval processes and given documentation, standard operating procedures to the requisitioners, the folks actually filling this out, that's going to go back on procurement and finance to adjust the PO process or adjust the PO itself, which is, again, a time suck, just correcting errors when they could be fixed when the PO is actually created just by influencing human behavior. And then in addition to that, you've got your PO, right? Even if it's gone through a PO process, manual process, great. A lot of the time savings gets recognized when the invoice is actually received. So you did all this upfront work on the PO, right? You're working hard, you've implemented a process that is scalable, people understand it, they can use it, they've got access to it. But when your PO comes in or your invoice comes in and it matches to the PO, if you don't have an effective 2 or 3-way match variance control and process to handle those different scenarios, a non-PO invoice, a 2-way match, and a 3-way match, then it's not to say it was all done in vain and you've lost all that, all that time spent, but that is a huge conversion or a factor where you can really streamline or see an ROI on this process. So in a manual process, again, when the invoice comes in, a lot of the time, the accounting team is pulling up the PO, whether it's a paper PO, maybe they have to log into a different system, match it line by line. So a lot of the times organizations order from Staples or CDW, Office Depot, sometimes Amazon. And so office supplies, things like that, typically there's tons and tons. There could be 50, 100 plus line items on any particular invoice. Someone has to manually review that, right? They've got to look at what's been approved on the PO, what's actually invoiced, and that takes way too much time. And so this is, again, manual process is better than no process, but you've still got pretty significant downstream effects really affecting accounting, the entry and the review process, which is then going to still affect finance and treasury, because the longer it takes to enter an invoice, chances are you're probably missing out on early payment discounts, maybe getting late fees in some scenarios. But again, manual process is better than no PO process. It shows a step in the right direction. And you're almost there. It typically doesn't take much more, to push that over the hump, get it all in one system and completely automated to handle all those different scenarios.
Sounds good, Alex. Now, you mentioned 2-way match and 3-way match. I'm pretty sure most of our audience knows what those are, but maybe not everybody. Could you just give the quick foundational description of 2-way match and 3-way match?
Yeah, absolutely. So a 2-way match is just a match between the PO and the invoice. So when we have an approved PO, again, a lot of, there's upfront budget approvals and things that we want to implement to control spend and control coding and automate coding. So a 2-way match is simply matching that PO to your invoice transaction. And again, even in a manual process, a lot of that review can be, manual review, still prone for error. So ideally, your organizations can implement a system where the PO record and the invoice record lives in the same system, because a lot of the time, the systems that support both transactions can implement variance controls. And when I say variance controls, again, just using that real live example, it's just a variance between your PO, which is your approved spend, and your invoice, which is your actual spend. So if, we've got an approved spend for 36,000, Zoom info comes in at, 40,000 for whatever, they added some additional user license seats, that can influence the approval process further. So again, in simple, that was a long-winded answer. There's a lot of different scenarios to consider, but it's simply just a match between your approved spend, which is your PO transaction, and your invoice, which is your actual spend. And then our three-way match. So if we're talking about kind of golden scenario, what everyone in the accounting and finance org strives for, it's that three-way match scenario. So that's where you have a PO transaction. So your approved spend, it's already coded, it's set up, it's tagged to the appropriate budgets. Receipt of goods is this third element in this three-way match scenario. So that's when, let's say, again, I buy some software. I, as the purchaser or the buyer, mark a receipt of goods transaction. So that's a way to verify either service had been performed or goods received. So three-way match is, again, PO, so our approved spend, our receipt of goods, which is just another transaction definition in our system and in general. And then we've got our invoice. So that all matches up completely. We've got a three-way match. I call it our ideal scenario because that's the scenario that accounting loves, right? They see an invoice, it matches up to the PO, it matches up to the receipt transaction. A lot of the times they don't even need approval on that invoice because it's already been coded. We've got budget approval, someone verify, we can go ahead and pay this vendor by marking a receipt of goods transaction. So this is kind of a straight through process. This is the most automated, most ideal scenario in the accounting or accounts payable world.
So the receiver document, I guess my understanding has always been could be a shipping label, or it could be an internally generated document that shows that the goods or services were in fact received. It might be digital, it might be paper, some artifact.
Yep. It's typically a combination of both when you look at any spend management system. So there's an electronic record, which is just it's like a PO-123 or a receipt or an invoice object. And then there's supporting documentation that goes along with that. So a lot of the times, a mobile app can be accessible. So if I order widgets, kind of pivoting to a tangible example, tangible goods being ordered. If I order something on Amazon for my work from home setup, when that good is shipped and I receive that, I'm going to pull out my phone, use my mobile app, take a picture of the packing slip. That creates a receipt of goods object or a transaction. And then that's what matches up to the invoice transaction. So you've got all three data elements and the supporting documentation to support that information.
Thanks, Alex. So everybody who's listening, we're moving from the slide called manual process to the slide called poll question. This is our second poll question. I know you're thinking electronic PO process. That comes after this one. So this poll question is select all that apply. Our payables process is automated payment generation of the following types: checks. In other words, it'll do the full check run at once. Virtual card, it'll create the virtual card entries to be sent. ACH, other rapid electronic payment options such as real-time payments, wire transfer, something else called other, or I am unsure. So we had needed, I think 10 more people to type the word pay or pull. I think we are now at our total. So we've hit that. So we will share the poll results. We'll go ahead and select all that apply on this list. If you select I'm not sure, it probably shouldn't be, you shouldn't select anything else other than I'm not sure. So we've gotten enough responses and we are set. Everyone will receive it, not just those who type the word pay or pull in the chat box. So thank you for your responsiveness there. All right, it's up. ACH dominates on this. Alex, 3/4 have that. Wire transfer is 50%. Number 2 is check, 61%. Pretty impressive that check is not number 1. So any other thoughts on this mix here?
Definitely. I mean, I think this is this is pretty interesting, right? We've still got a lot of checks processed. Every time I see that, plus 50%, it makes me cringe a little bit, right? Because checks, they take a long time. They're probably the most prone to fraud, in my opinion. And then virtual card too, virtual card, seeing that 35%, that kind of excites me because virtual card is kind of the latest and greatest technology, kind of relates to, the percentage on the PO, the automated PO process. So virtual card is really cool. I love talking about virtual card, since, most of our audience are in the treasury department. So for those of you who haven't been exposed, maybe this is a new term, or maybe your organization's not utilizing it. Virtual card is just a way to pay your vendors with a virtual credit card. So a lot of banks, like a lot of banks, a lot of systems, AP automation systems, spend management systems in general, are kind of pivoting or focusing a lot of their efforts on virtual card payments, because when a credit card transaction occurs, there's a shared pool. There's an interchange essentially associated when that transaction occurs. So the merchant typically takes a fee of, let's say it's 3%, just as an example, or 220 basis points, whatever that fee is. So the great thing about that is there's additional revenue or cash flow that can be captured simply by paying your vendor. And a lot of the time you can influence the vendor to accept MasterCard as a form of invoice payment, almost as like an early payment discount. So if we pay your invoice today, you'll accept MasterCard within, certain, maybe net 10, for example. So it's very similar concept to an early payment discount. In addition to, rebates that come along with virtual cards, there's also fraud, right? Fraud prevention. Virtual cards generally are a unique credit card number and CVV code associated with each transaction. So if you pay an invoice, that credit card can be swiped once. It can be used once. And so credit card stolen, guess what? Funds are used. So this is cool because it disappears, right? It prevents any future potentially fraudulent activity happening on that virtual card, because it's typically a one-time use virtual card. And then ACH is also great. I love seeing that 73% of payments ACH. So ACH is also very ideal. When you have a manual PO process, it can still be a pain to collect the ACH information. And that's probably why there's still a large percentage of check, because a lot of the time it's manual. You have to reach out to the vendor, get the routing number through email, get the bank account number through email, and then someone's got to load the transaction. Again, room for error there when keying in the routing number and the bank account number into typically the ERP or the accounting system, wherever the payments are initiated from. And then we've got some international, some wire transfer that could be domestic as well. But it's nice to, again, have such a wide variety of payment methods used. International also, if any organizations, or if those are cross-border transactions, one of the benefits is being able to process all payments from one system. So again, a lot of more enterprise grade organizations or systems out there can handle 100% of invoice payments, of course, Corpay included. But again, interested in hearing more and engaging with the audience on these different kind of thoughts and ideas around these various electronic payment methods.
Yeah, some great data. So thanks everybody for responding to that poll question. Now, prior to my trick about asking about manual process, then we go to electronic PO process with the goal of better timing and efficiency through better information, better visibility, a consistent look and single view of the truth, if you will, between companies. Alex, how do we think about this differently from the manual process side?
Mm-hmm. Yeah, so this is, we've spent the last 40 minutes or so talking about how bad and terrible a manual or a no PO process is in general and all downstream effects. So when we consider an electronic process, first off, there's a couple slides on remote capability as well. But the idea here is to make the PO process accessible. So it's great, right? If you implement a PO process, you've got, approvals built out, you've got finance within the approval process for budget check, you've got two-way match and three-way match scenarios set up. But your users have to use it, right? They need to be on board with filling out forms. And so a lot of the time when it is a manual PO process, it's not going to happen, right? They're not going to, it's a painful process to fill out a form manually or send a request through email, get a response, and then order those goods. And so because this PO record typically, it can be accessible to everyone in your organization, right? Anyone who spends money in the organization or has the authority to spend money can request a PO theoretically. So you want to reduce as much as possible the pain within that process. So when it comes to accessibility, when an electronic PO process is implemented, your users can have access to submit a purchase order through, a mobile app or just by logging onto their computer. Maybe it's in, IT's hands, something happened. They can still use any device to access a web portal, punch in whether, Chrome or Safari, whatever web browser they're using. They could just go to, in our case, corpay.com to access that record. And if they need to spend or submit a spend request, this is first giving all of the users accessibility and ease into access into submitting a purchase rec. And then also an electronic PO process. Again, when it comes to, I love talking about punch out. So punch out is really just the concept of further streamlining the ordering of tangible goods. So when I'm a user and I'm filling out a PO form, typically I include what I need to buy in that purchase request. So punch out allows you to punch out to the supplier's catalog. So if, let's say, you need to buy something on Amazon or CDW, Office Depot, the whole theory behind this is, again, to reduce the pain in the process, because it's not fun, right? For someone needing to buy something, they're not going to want to adopt it. They got to do all this additional processes. They got to get proper approvals. It's painful. And so the idea is to, again, reduce the pain, make it easy for them. They can log into a nice UI, have access to reporting. They can banter with the vendor also directly. So typically it's nice to have a centralized place to go back and forth with the vendor on pricing, or maybe there's a question. And so a lot of this, when it comes to electronic PO process, it also helps the vendor relationship, which I'll touch on in a couple slides. Don't want to get ahead of myself again. But Craig, anything to kind of round things out for us?
Well, just a couple of things. I liked how you kept talking about the punch out process of being efficient. That seems quite important. That's not a term I'm as familiar with, but this idea of a central system, single version of the truth, it helps not only within the company, but the other trading partner as well. If you can provide some visibility into, here's what I've ordered, or here's what I've sent, here's what we've received, here's what we've invoiced, here's what we're planning on paying. All of those reduce points of friction, points of issues where there's, people are circling back on it. So just a couple of comments there. And Alex, this brings us to our third and last poll question. This is multiple choice. So we end with a nice multiple choice. In the chat box, you can follow Corpay, CTM File, and Strategic Treasure. Please do that. That makes us really happy if you do. On the implication side is the question. We look at payments and the payments process as a cost center or a profit center, and then an area ripe for fraud requiring improving security. A key component in our management of liquidity, just another finance area, other, I am unsure. So whichever ones you'd like. And we have enough responses so everybody get the poll questions. So that will be a test if you're listening. Or we'll save the pay for the next webinar too and use those to apply to whatever count I just happen to randomly pick. But in terms of the implications, like what are these views? Looking forward to seeing those and commenting, and we get to the point where we'll accelerate towards the final thoughts. We have a few more content slides. So, Alex, we have cost center is 50%, profit center 19%. I think if you went back 10 years, it'd be hard to get over 5 or 10% saying it's a profit center. So there's some progress there, particularly with different types of rebates on card programs, et cetera. Area ripe for fraud, 34%. I'm surprised that only 50% said it's a key component in our management of liquidity. That surprises me.
Mm-hmm.
What about you? Any thoughts?
That's interesting. So I think a key component in our management of liquidity, I would guess almost 100 plus percent of users would agree with that, since it's got to it's cash flow out the door. A ripe area for fraud. I mean, they're payments. So of course, there's always room for error, room for fraud, whether there's a bad actor, in this case of fraud, of course, sometimes there's, bank account information was entered incorrectly. So it could just be a failed payment that needs to be troubleshooted and remediated. There's a lot of organizations, so a ripe area for fraud, 34%. I think it is, right? It's got to do with vendor payments. This is where fraudsters typically focus on, right? They can potentially hack a system, load fraudulent bank information. And so it's important if your organization is at a stage of considering, how to implement not only a PO process, but just a spend management process in general, focus on this area, because there are different kind of trains or theories on how to minimize risk when it comes to fraudulent payments. There's a lot of system built controls around verifying payment methods up front, both through electronic or data interchange. So when a payment method is entered into a system initially, before the payment even goes out or the invoice is received, you can verify those payment methods up front. So there are controls you can put in place when the vendor is actually being added to the system, going through a contract review. So typically I see organizations implement control. It's a combination of system controls and kind of human checks. But when it comes to an approval process around a vendor addition, right? So when a vendor's being added to the system, to the ERP for the very first time, you can go through approval processes, right? So finance, accounting can approve these vendor additions before they're marked as active and eligible for payment, right? So that's a combination of a manual approval process and an electronic check, essentially, to verify account holder name matches up with the legal name of the vendor. So there's kind of technology solutions that can help streamline fraud prevention. And then also Plaid, right? A lot of organizations use Plaid to verify or actually require the vendor to load their bank information through a login to their bank account via a Plaid integration. And then the profit center, right? So this is 20%. That's good. That means 20% of the respondents are probably using virtual card, because that's how you turn your treasury department from a cost center into a profit center. A lot of the times, these virtual card rebates have blown me away. They've a lot of the time, they can actually pay for the software in terms of the end-to-end process, vendor onboarding, a PO, streamlined approval process. You've got your spend controls, your budget controls. You've got an automated process to reduce costs within AP or just spend management in general. And then if it's a profit center, right, a lot of organizations can actually pay for 100% of that software, and you get to implement a streamlined process around it. And then cost center is just kind of obvious, right? We're paying vendors, so of course it's a cost center.
Sounds good. Yeah, that brings us to drivers to automation. What makes people make the shift to automation? I'll talk about the last one, let you cover whichever ones you'd like to, Alex. The competition is moving to automation. This sometimes is compelling in certain industries, and sometimes it's not. That's a motivator in some industry verticals, and it's not much of a concern in others. But no organization can do well without really focusing on their efficiency, and efficiency almost always requires automation. So that's one. What are some of the other highlights there,
Mhm.
Alex?
Yeah. So remote work, definitely, right? COVID happened, organizations and employees are vouching for hybrid work schedules, remote work schedules in general. Even organizations that are not, it's important to, again, make a system accessible to your users so they use it and you can realize the benefits of, consolidated and streamlined procurement process. And then generational demand, right? I'm a millennial, and when it comes to data, right, data entry or manual processes, I mean, right, they're just kind of unacceptable when it comes to the younger workforce. We just don't tolerate it, really. Like, this, come on, like, what are we doing here? We got to move faster, we got to streamline, we got to automate. And so, right, keeping employees, younger employees happy, and at the organization, I think is pretty key. And then it kind of also relates to competition, right? The labor force, it's a very competitive market. There's a lot of forward thinking organizations that make the, not just the PO process, but just in general, it's a way of thinking to kind of streamline and being competitive in the market, against competitors, but also in the job market. Just lobbying for the best workforce, and then supply chain relationships. So we don't really talk about this much, but I'm glad this is a key point in this slide. So vendor relationships, you want, in general, right? You want to have a good relationship with your vendor. It's always transactional, right? You've got an agreement with the vendor, they pay you. There's an exchange of money for services, etc. But maintaining a good relationship, I don't think that's focused on enough in a lot of discussions around procurement and accounting in general. But that can greatly influence your experience with the vendors that you deal business with. They give you, potentially better rates and discounted payment terms, things like that. And so it helps fuel your organization for continued growth when you have vendors who want to do business with you. Because unhealthy relationships, chances are they're not going to, treat you the best if they don't have visibility or don't have a method to communicate or negotiate with you.
Right. So what are some of the key consideration or areas to consider when we look at automation? I'll start with a couple and let you finish us off there. It's the issue is how, if we put automation in, what are the types of steps we're eliminating? Kind of like the fallacy of the line. Which are the biggest, most involved steps that are manual that generate error? So how much will that relieve us of the manual task? And then the second point is what we're doing now, if more of it's manual, or even if it's automated, if it's not automated the right way, how will that allow us to scale? What will help us scale most properly? Yeah. Go ahead, Alex. I know there's a couple more here to talk on.
Pretty straightforward. I would, just ask the audience to, think about these questions, have them resonate, go back, sleep on it, and, go to your organizational leaders once you have answers to these questions. But I think this is a good starting point, right? Just take a hard look at the organization and the process and determine, if what payment methods and files are supported. Will I need additional vendors to handle payment execution, credit cards, underwriting, anything like that? These are just good kind of fundamental questions to ask yourself and your organization to identify those next steps to improve the process.
Great. And then that brings us to our final thoughts. Why don't you start us off? I'll cover the last two if you take the first two.
Sure. Sounds good. So just to kind of wrap things up, impact, right, clearly affects multiple departments within your organization. It's typically riddled with manual process and data entry and human error. overspending. So I think that's, we've kind of tried to drive that point home. And then automation, right? We've talked a lot about implementing a process around control and budget approval and automation with the two-way match and the three-way match and punch out. It also has to do a lot with scalability, right? So part of the reason, almost the major reason for implementing a PO process and standardizing that process is to allow your organization to be scalable. So when you have those predefined processes in place, you influence your requisitioner's behavior, that process is scalable. And organizations that don't have necessarily a scalable process, if they have a manual PO process, it's going to create a lot more pain as your organization grows.
Yeah. So the third point here, the thoughts. What's some of the mindset that's necessary? Your competition's automating. We all have to improve how our organizations run. And the idea of, if I automate once, now I'm going to realize the benefits from them forward. It's annuity providing benefit going forward. And the other part is, where are we technologically? Automation is far, far easier now than it was 3 years ago, 5 years ago, 10 years ago. The tech is better. It's easier to integrate. This matters. So the payoff is there usually more quickly. It's a challenge because one of the biggest constraints tends to be availability of IT resources. And so the better the tech is today, the less of an impact it is on the IT resources that you have. And then finally, from an inefficiencies perspective, where are you most inefficient? If you draw out that chart of all those rectangles going from one area to another, where are you most inefficient? Can you eliminate steps? Or can they be simplified? Can they be automated? If you have a digital handoff, you have less opportunities for error and less time absorbed into the system of people tracking and trying to balance a manual handoff as opposed to a system-to-system integration. But when you look at these changes that you make, measure the benefit, measure the change in errors, the decrease in error rates, the throughput, the scalability, measure those things and track them and show them to your organization as you roll out this project, and that'll provide you with additional fodder and support for other projects. I'll drop us onto our last slide with just a minute to go, and Brian can take us home. Thank you so much, Alex. Thank you, everybody, for listening. And Brian, what's coming up next, and how can people stay in touch?
Indeed. Thank you, everyone, for joining us today. The CTP credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And for more on effective expense management, be sure to register for our next webinar with Corpay by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.